You make a bad trade, you can explain it to your investors. You have a trade fail, you have an operational issue, and you're done.
All these different operational aspects, raising money, that's a whole different beast, and that's a huge challenge.
My guest this week knows what it's like to build hedge funds across continents. Daniel Xystus started his career in California, running a $2 billion quant book for First Quadrant, and then at Chicago Equity Partners. Eventually, he lands in Hong Kong as the director of quant strategy at AIA. Today, he's the founder and CIO of DAX Advisors.
It's not easy to short in some of these markets. Sometimes these markets will turn shorting off. They'll make it very expensive. You go to Asia and you might have 1, 2, 3% shorting costs. And that's a lot when you actually have to try and make money on top of that. Your backtest might actually look good because it's not actually easy to capture that alpha.
Daniel, you're an American living in Hong Kong. You've done work in the Middle East. You're advising clients on all these funds globally.
U.S. is the biggest economy, but China's number 2, and it's got more people than the U.S. I think there's going to be a lot more growth in China. And as for the Middle East, you're going to see a financial center that's going to be in that region.
Hey, thanks so much for listening to Odds on Open. When I look at the back end of our YouTube statistics, I can see that only around 22.8% of you guys are subscribed. And I'd like to ask a favor. If you like the content we create and you do want to help us grow this show, get the best guests possible, and make our production quality higher, if you could consider hitting that subscribe button, I would really appreciate it. And I promise I will do my very best to bring you guys the best guests, the best conversations I possibly can. And by subscribing, you're helping us do that, and you're also part of our story. Thanks, and back to the episode now.
Daniel, thank you so much for doing this. Let's say tomorrow I start a quant hedge fund. How do you know I'm going to succeed?
No, that's a very interesting question. And I think there's a lot of people that are trying to start these hedge funds and really want to succeed. I think the first thing you need to do is what's your strategy? Where do you sort of think you actually have an edge in this market? You can do anything from factor investing. You can do things such as high frequency trading. There's a lot of different ways that you can actually try it and make money in this market. But once you have that, then is the question of what markets you're going to invest in, where you're going to actually set up your hedge fund, and then you got to think about all the operational issues that actually go into that as well. And there's a lot of things that you have to consider when you're running a fund. And things have changed in terms of structure. People used to think, well, I'll just run a Cayman fund and I'll have my hedge fund and it's all great. Things are a lot more regulated now. Investors demand to have a lot more transparency. So you just can't just leave these things to chance. You need to have everything along the way be something that looks professional and that investors are happy with you, because it's not just your strategy, but it's also the operationals. Because what I've also told a lot of people is that you make a bad trade, you can explain it to your investors. You have a trade fail, you have an operational issue, and you're done. So you have to be very, very careful about how you set this up, what regulatory environment you're going to be in, and all those things that are behind the scenes that people sort of forget. Is you're going to have to get yourself a good chief operating officer, someone that can help you run things on the back end to make sure that your trade ideas get executed promptly, and you can actually use your implementation to actually make sure that you actually make money from your trade ideas. So I think that's the key, is not just figuring out I've got a strategy, but it's also the next step of actually the execution of your hedge fund.
That's fascinating. A couple of weeks ago, I had Christina Chi on the podcast, and she was saying the same thing, that, she expected running a fund to be just like running your own money. Same thing with Renee Yao, who used to work at Citadel, ran money at Millennium and then another prop trading firm. And they were both saying that, all these different operational aspects, raising money, that's a whole different beast. And that's a huge challenge. I'm wondering, from the you've been in this space for a while. I'm sure you have plenty of friends who've also been in this space for a while. Where have you seen the greatest operational difficulties come, particularly for startup fund managers in the quant space?
I think first of all, it really depends on it's location dependent. I think if you're going to do something, if you're running something US, it's a lot simpler, especially if you want to do, am I long only or market neutral? And if you're a hedge fund, you're really going to do some shorting. It's very easy to short in the US and some of the major markets as well. If you do something where I was doing, which more of Asia ex Japan, it becomes very, very difficult. Those markets are, it's not just defining a strategy, but a third of your time is actually operational issues. It's not easy to short in some of these markets. Sometimes these markets will turn shorting off. They'll make it very expensive. So you have to figure out, do I short the stock itself? Do I actually go through swaps? How do I actually put this all together and actually implement it? And if I can't actually get a proper short position, maybe you short an ETF. So when you're doing those types of markets, and that's where once you sort of say, well, there's not as many players, or maybe I like to do China, well, then there's operational issues that might actually eat away at your alpha. And your backtest might actually look good because it's not actually easy to capture that alpha. So that's the question you have to think about. And there's a lot of things that when people come from, especially if they've got exposure in US markets and actually how to run funds, they realize that when they move away from those markets, it's a lot different. And then plus, you have to think about, if I'm doing foreign markets, how do I manage FX? Asia ex Japan has a lot of different currencies. So there's a lot of different currencies you have to manage as well. So these operational issues become a lot more apparent and important when you're doing something outside of your normal markets. And that's where you actually have to think about how to actually make that happen. And then your prime brokers become one of your key players that actually helping you understand these markets and really supporting you through that process. So that's where I think it's very interesting, because it's you get something where you might have less than 1% on shorting these things, and then you go to Asia and you might have 1, 2, 3% shorting costs, and that's a lot when you actually have to try and make money on top of that.
100%. And I think, there's a reason the U.S. markets are the most liquid. They're the easiest to trade. They have the best companies so far. And, one of the things you were mentioning there is how the shorts can be extremely expensive. You were saying 1, 2, 3%. Like, I'm thinking in my head, putting on a trade, even if you have edge, if you're losing that amount, if that's the cost to short, it's debatable. I'd like to hear about that. How, from the people you've spoken to, who trade the Asian markets, how do they tend to deal with those issues? Are there relationships? You mentioned relationships with prime brokers. I guess I'd just like to dive a bit deeper into that. How do people tend to deal with those things? Let's say if we're putting on a short position, how do people evaluate, I guess, if the edge we have in this trade is worth the cost that we incur in putting on that trade?
Well, and that's a lot of things when you're doing your back tests. That's when you actually want to actually incorporate these costs. And of course, that's very, very difficult historically, because you don't necessarily have good data going back in time in terms of when these shorts are, what the costs are. But you're right. A lot of times you will look at a trade and say, this looks good. Let's go out and try and put it together. And it's the same thing like any other trade. Sometimes you want a stock that's long, and right when you're about to buy it, it jumps 10%. Well, then you got to look for someplace else. Similarly, if you've got a short you want to put on and it's very expensive, you got to say, okay, well, let's look at something else. Or maybe I'm willing to take a basis risk. That means instead of shorting a particular name, maybe I try to short an industry or an ETF so I can get my long position. Because again, the shorts have a couple different functions. One, it allows you to make money when stocks go down, but also it allows you to actually get up your gearing, because if you're doing long short, you could have as much as 2 times the longs and 2 times the shorts, or 1 times the long or 1 times the short. And if you don't have a lot of shorts, you just start ending up being a long only fund, which is not what you want to be. So you're going to have to bring down your risks somehow. And so that's when you have to sort of reevaluate, where else can I get some of these names that I can short. Now, luckily, when you've got a lot of this computing power, you can find things that are trading similarly, and you can find something that perhaps works. But in some of these markets, you actually don't have a lot of choice, and then you have to start thinking, what am I willing to risk my allowed to take or willing to take in order to put on my long position and what short position works for me. So I think there's a lot more complication when you put these things together. But again, that's what these hedge funds are getting paid for, is finding out actually how to implement their trade ideas as well.
So right now you're a hedge fund CIO advisor, and you specialize in understanding, I guess, the geography. You talked a little bit about the start about the Cayman, Middle East. You're based in Hong Kong, where I've also lived and love, and we can get into that later. Where do you see the greatest need for your services? Where do people struggle to understand these nuances the most of, like understanding the government policies around shorting, and maybe you can advise them on that. I'd love to hear about that whole dynamic.
I think from my experience, I've looked at doing a Cayman fund. So I've done using a Cayman structure. I've done shorting in a UCITS structure. So things that are very relevant for people that live in Europe, because Europe really likes UCITS type structure. And then in Asia, there's a lot of different structures. There's some new structures now in Singapore, their VCC structure. So those are kind of very interesting. So I think that's where I think people can actually take my expertise, especially if they're coming to Asia, or if they're trying to set something up in the Middle East, because I've actually run money in the Middle East as well. And so I think, given my background, I was very attuned to actually trying to figure out actually how to find the structure that works for my investors, that works for me, that also allows me to put things in place. And so I think those types of experiences really allow me to actually sort of advise on people that are trying to start up their funds. I mean, of course, you could also go to your hedge funds, your prime brokers. They'll give you some advice, but sometimes it's also good to get someone that's not in the prime broker space to kind of give you something a little bit a step back, and I can really go through it and give you some ideas in terms of what type of trade ideas may or may not work. Because a lot of things, for example, if you're doing like an Asia ex Japan, you face a lot of interesting questions. Korea is very difficult to short, but also if you want Korean exposure, or Korea and Taiwan, you tend to be all tech. So you start introducing tech exposure into your fund, and if your tech is very liquid, but you want to short the market, then you might actually end up with an ETF. So again, you get tech exposure in the overall hedge fund. So there's a lot of different things we need to figure out. And I think that is what was very interesting, especially when people try to get into China, because I think the hottest markets for growth is perhaps trying to invest in onshore China, which has a lot of other regulatory issues you have to think about. And then there's also a lot of people that are basing things out of the Middle East. Again, you can just run global funds from the Middle East. You can run them from Dubai, but then some people actually want to look at the local markets as well. And there's some interesting things going on in the Middle East. So there's a lot of different ways to think about things, especially for people that don't want to do something that's just in the U.S. If you want to do something in the U.S., I think most people don't really need my services. I think they can figure it out. But it's when you sort of drift away, I think that's where I can help.
So let's say I want to run money, the entire market, X the US. So let's not include the US. And let's give this as an example, because I think it'd be interesting for our viewers to go through this thought exercise. What sort of questions are you asking me? Let's say I'm starting this fund. What questions are you asking me? What you need to know more about before you advise me on my structure?
Yeah, I think one is getting a brief idea of what your strategy is. So you'll pick some type of strategy, and then I'll ask you, well, does most of your trade ideas come in the large cap space or in the small cap space? Some people don't actually think about when they're researching it and tying it down to liquidity, and they don't actually model that properly. So sometimes, especially if you look at historically, most quant funds, most of their longs are not in the mega caps. So they're in the smaller cap space. So you're going to have a cap issue that you're going to have to manage in some way, which isn't terrible. In the U.S., even if you went down to mid caps as your longs, they're still pretty liquid. But when you start going into other markets, especially ex-US, then you might have some difficulties. Then the question is, how are you going to, first of all, what currency is your fund going to be denominated? Usually it's going to be dollars because most of your allocators are US money. So they want to have USD. So you have to think about that. And then how much each region are you going to focus on? Are you going to, because outside of US, people may not realize this. If you look at an index fund like MSCI World, US is about 60-65%, might even get higher now, of that world index. So it's massive. And then the next ones, you're going to get your Eurozone, you're going to get Japan, and then you're going to get, and then China's going to be in there as well. So it's really a question of, do you really want to be everything? Do you want to actually deal with a little bit of Brazil and Latin America? Do you want to do anything in Africa? Or do you just want to say, well, ex-US, I'm just going to focus on Europe and then Asia, which is not a bad idea. And then it's like, okay, where do you think your prime trade ideas are coming from? Most likely they might come from, maybe they come from Asia, because there can be a lot of stocks in the Asia markets that might have interesting, because they've got a lot of tech exposure. And so it's really trying to figure out that, and then saying, well, where are you going to be based? Trading for Asia is much different than trading for something in, say Europe. And a lot of people sort of forget this. Now, for example, if you even had US in, the question I always had for some of these managers when I talk to them is, it's like, well, if you could either be on US hours, and then you can't trade 24 hours a day. There's only so many hours in a day you can actually trade. Unless you have two traders, you can do that. Some people, when they're small, they'll actually send out a basket to their prime brokers and let them figure it out. I never quite like that as well, because again, things can jump on open, but you have to figure out what's your philosophy and how that's actually going to work for you. So how are you going to interface with your trading desk? Who's going to execute your trades? And then how this is actually going to come all together. And then the other question is, are you going to be market neutral within each region? You don't have to be, but you can say, are you going to be a little bit long Europe and short more Asia? Or are you going to make sure that you're market neutral Europe and market neutral Asia? And that's just sort of the beginning questions of how that all sort of comes together in terms of, and I can go on and on these things, obviously.
Yeah, no, and I think it's a fun exercise. Let's do this I want to push this a bit further. So let's say, actually I'm thinking about this. I'm Asian, lived for a little bit and lived in Manila, lived in Hong Kong for a little bit. And let's say I only want to trade Asian markets. Something at the top of my head, Japan's really interesting. Korea too, Taiwan, interesting stuff happening there. Hong Kong markets seem to be doing pretty good this year. And so, let's say those are the markets I want to trade. East Asia, East Asia, not Europe anymore, not the Middle East. What would you advise me to do in that position?
In that position, first of all, I'm assuming you're going to be market neutral, so that having Japan actually helps, because Japan is actually a market that is quite liquid. So a lot of managers that have money in the in the Far East, Asia, they will actually have a big part of their short book in Japan, because it's cheap. It's almost like US in terms of shorting. So it's a lot better than a lot of the other markets. Now, if you talk about Manila and Philippines, there's not a lot of stocks there. And in fact, anything that's liquid, you're only going to be long. You're not really going to short. Hong Kong, again, it's got some interesting names, but you still have the issue where there's still not a lot of names to choose from. If you're doing China, you're going onshore, yet there's a lot more names to choose from. So you're going to have to start running it now. It would just make sure that your back test, when you're looking for how this actually works, is start looking at your portfolio that comes out and looking at your risk analytics, because risk is very important, and make sure that if you're comfortable with that level of risk you're taking, because as you start putting this portfolio together, you might start saying, oh, I can do a little bit of short in Hong Kong. I can keep Japan market neutral. Anything else that's any of the ASEAN markets, I'm just going to have to be long, and then try and set that somewhere else. But I think that's what your portfolio is going to look like. You're going to have a big book, leverage book in Japan. You'll have some in Hong Kong. If you want to do anything else on the periphery, like Philippines, it'll just be a couple names long. And then you actually have to figure out if that's actually worth it to you. If you can only take like a percent position in a Philippine name, depending on your size, then it might not be worth your time. So I think usually it would to start off with, you might just say, I'll do Hong Kong and Japan, and then over time maybe added some of these things on the side as things actually, as you grow and you actually get a little bit more familiar with the region.
What you mentioned there about the lack of liquidity in the Philippine markets, 100% agree. It's insane. Like when you actually look, I think, I don't know what the volume was last week. I remember hearing like 7 billion pesos here, which is around like just over $100 million. It's like, what? The entire market?
The entire market.
Oh, like that's ridiculous to me. Like if even someone who, let's say you have a $5 or $10 million portfolio, which in the US you'd be a small fry. Like you can't get out in the Philippines. It'd take you a long time. You'd be dumping those positions for a long period of time. And that's not even considering the fact that maybe you're not buying the large cap names. And large cap, obviously, large cap with a like grain of salt compared to the US. But no, for sure. Like the lack of liquidity, I think it makes it very difficult to attract like institutional players. Like it's just not happening. And I guess I'd like to hear more about your career, because Daniel, you're an American. Correct me if I'm wrong. Living in Hong Kong, you've done work in the Middle East. You're advising clients on all these funds globally. I guess I'd like to hear a bit about your background. How long you've been in the quant space, and then like because I know you've traded on the buy side, and then like running billion-dollar books, and then also more recently AIA. Would love to hear.
Yeah, sure. No, I think the easiest thing is, I mean, originally I was one of those physicists. Actually, I studied astrophysics. I thought I would just become an astronomer. And then I sort of realized that I sort of made a turn into finance a little bit accidentally. I was something, I took a summer job and then realized that I actually liked the markets. It was something, there was something about the markets that was different than science, because science was all about finding like these eternal truths, but the market itself was much more of an interesting puzzle because you have this market psychology to it, which I found really, really interesting. So I was doing a lot of quant work. So I was working for a large fund out in Los Angeles. We did a little bit of long only, but we did some long short as well. And then I moved to Chicago, got my MBA, and was also working for another firm that was doing quant. And we had very, very large books. That was mostly focused on institutional in the US. And then once I was having a very good time, loved Chicago. It was a great place to be. And then a friend of mine from business school said, "Look, we've got this opportunity. Why don't you come to the Middle East and we'll try and sell Asia to Middle Eastern investors," because there was always a gap at that point. And you're talking something that was not quite at the top, because China did very, very well in like 2007, etc. 2006 and 7 was on a tear, and people thought it was going to take off. That's where you really want to jump into. So I did some ran some funds, Asia, ex-Japan, out of Kuwait, actually, out of the Middle East, which was an interesting place for to invest there. And then moved the investment team to Hong Kong, and then was running funds in the Hong Kong space. So I think I keep moving east. I keep doing some very interesting types of places to invest, and I think that's what I like. I like the challenge of it. I like seeing how people invest in different regions, so since I left the U.S., I haven't looked back, and I think it's been very, very good for me and quite interesting. And then AIA, it was just trying to help them improve some of their investment products and how they look at investing on that side. And it also gave me an insight into how things look from an insurance perspective, because it was even though it was the investment arm, they still had to look at things and tie things back to how it's actually money for their shareholders, for their products. And so there's this extra layer that I got to be quite aware of. But now I'm trying to get back into more hands-on investments. So I think from that perspective, given the fact that I've spent years in the U.S., that's where I grew up. and then spend time in the Middle East and Asia, I think it gives me a lot of flexibility in terms of finding the right people to sort of help them either advise on their strategies, advise on fund setup. And there's a lot of things that are going on right now in terms of attracting family offices. Hong Kong wants to have a lot of family offices. The Middle East wants to have a lot of family offices. So I think from my career perspective, I think it's going to be something that's going to be very, very interesting. And since when I was moving the investment firm, I did things beyond quant. I did quant, but I also did private equity and private credit and other deals as well. So I'm much more well-rounded, which I think is helpful for people that are setting up. If you're setting up a quant fund, that's just one set of skills. But if I'm also trying to if someone's saying, look, I want to set up a family office, or we want advisory on how we should actually set up the family office piece, they're going to want more than just equity or just bonds, or actually want something on the private side as well. And they want something a little bit more holistic.
It's funny you mentioned they're moving more east and east every year. I find that funny because you start off in LA and then you go straight from LA to Kuwait, or you go somewhere else first.
No, I was in Chicago for 11 years. So I grew up in LA, then went to Chicago, and then I was in the Middle East and then in Hong Kong. So but it's been interesting. I mean, it's been fantastic just living in those different cultures. So and once you kind of, there's a lot of different people that move overseas, but if you really like the variety of traveling in different countries, it could be a lot of fun. And it's great once you sort of get to that point where you're comfortable in a lot of different cultures.
How does the culture in Hong Kong, like particularly around the financial industry, how did that differ from places like LA, Chicago, I guess even Kuwait?
I think on the investment, side, I think the way Hong Kong itself is a very high-paced, fast-paced type of city. It's a financial hub. They attract capital from all over the world. Now, historically, before China was closed, Hong Kong was the way to get into China. You couldn't actually access China except really through Hong Kong, and that's really where Hong Kong actually took off. Now, as we get to where we are now, China's opened up a little bit, but Hong Kong still has that role. And so Hong Kong itself is focused mostly on looking towards China, and not just Hong Kong. And Hong Kong had a very tough time during COVID, but I think you're starting to see it come back. You're starting to see IPOs coming back to the region, and which is nice to see, because I love Hong Kong. It's a great place to live, but you weren't quite sure if they're going to recover from the years that happened during COVID. So I think from that perspective, they're willing to invest and they're willing to work hard. I think in the U.S., you get a lot of people love investing, love the markets, but a lot of the investments are mostly focused on the U.S. One, because the markets are so liquid, so they do it there. There are some global players. Sometimes hedge funds, if they're going to do global, they might put them in London for the overseas piece. They could put some people in Hong Kong. They try to get people on the ground, but you can still do it in the U.S. So I think from that perspective, you get a much more U.S.-centric type of investment style, where the other markets inform where the U.S. market might go. But there's not much outside of that. When you're outside of the U.S. and you're investing, that's where I think it's very, people may not realize this, that you always look to the U.S. and see where things are going. You see what trends are going and how that actually filters through. Local news makes sense and has an effect, but really the U.S. really kind of leads it, because it's so big in terms of market share and how they look at the world. And as for the Middle East, I mean, the Middle East is another big, important player. I wouldn't be surprised. You're going to see another financial center. It's either going to be Dubai or Abu Dhabi. It's one of those two, or it could be both. But you're going to see a financial center that's going to be in that region. There's just so many advantages to being based in the Middle East. And there's so much capital that's there that I would be surprised if you ever get something where you don't see a major financial center developing in the Middle East over the next 10, 15 years.
I want to unpack that some more. Like the Middle East becoming a major financial center. In my mind, I'm automatically skeptical just because I feel like culturally, from the educational perspective, as in, now I know that Brevin Howard is putting up a bunch of, like, there's a lot of articles about that, and I'm sure other funds as well. Um, and, perhaps you can recruit global talent to come and work in the Middle East, particularly, I'm guessing, London and European talent who pays 0% taxes, right? Which is a huge plus for a lot of people in the financial industry. They get to keep those bonuses and enjoy life. But I guess I'd like to hear about that because I guess I'm skeptical. Why do you think that that those two, Dubai and Abu Dhabi, one of them or both, can truly emerge as financial hubs? When I guess I imagine that talent side of the equation is extremely important.
Well, I think the talent is an easy one. I think you've mentioned some of those, some of the reasons there, because what people don't realize is that, for example, if you're from London, you're already paying, or even continental Europe, you're paying 40-50%, and then you go to the Middle East, you're paying zero. So all of a sudden, you could take a pay cut in some ways, and you're still better off. Now, U.S. citizens get global taxation, so it doesn't really benefit us all that much. It does help a little bit, but it's not as big as you're seeing from Europe. So I think you're going to still see lots of European talent coming in. But also, again, you have a lot of players that are from the Middle East. They might go to U.S. schools, or they might go to UK schools that have great education. They can come back to the Middle East and actually make things work. The Middle East also has a very an advantage because they're right in between Europe and Asia. So you can be based in Dubai. You've got 7-hour flight, and you're in Hong Kong. You can do 4 to 6 hours depending where you want to go, and you're somewhere in Europe. And you've got the fact, and some people like it, the fact that it's not cold. I mean, it's hot, but you don't get winter. You don't get a lot of rain. So I think some people really like that type of environment, and you've really seen that what Dubai is today versus what it was 10, 15 years ago is a lot different. And they're really pushing innovation. They're really pushing regulations. And I think what you've seen is that every time, no matter what industry you're into, it's always sometimes when you need to have almost like a new rewrite. And that's sort of what Dubai is and Abu Dhabi are able to do. They're able to actually build the regulations from today's perspective. They don't have any legacy, so they can have the regulations that are solid, that give investors comfort, but are focused towards things that look at things such as digital assets. They can look at things in terms of how do I actually run money globally from this place, from the Middle East with different currencies. How does that work? And that's where I think they're going to get some of that advantage that's coming back through, is because they're able to actually build something that actually is more fit towards the times. I mean, the U.S. and Europe, I mean, they can always change their regulations, but it's always tricky when you have to sort of start from something and change something when people are already used to some type of regulation or regulatory scheme. This is where I think they're going to be able to just build things from scratch, and it's going to be something that's going to be quite helpful to them and really help their growth going forward. And I think the taxes are just one aspect of that, because there's also a lot of other regulatory regulations in other regions that can be quite costly and time consuming, and this will actually help them be more friendly or friendlier to investors in setting up a fund. Because today there's a lot of regulations when you set up a fund. We've already touched on those before, but there's also anti-money laundering. There's all these things you need to worry about setting up a fund on the operational side, that you need a place that you're confident you can actually get it done, and the less regulations you have to deal with. I think a lot of funds are happy to do that. And that's where you're seeing the Brevin Howards. That's where you're seeing your Citadels. You're seeing a lot of these big shops set up in that place for that reason.
What are some of those regulatory hurdles or barriers that are present in other markets that Dubai or Abu Dhabi makes easier or more convenient for emerging managers or even existing ones?
there's a lot of it has to do with more of streamlining some of the regulations. So the thing is, what they have to be careful of, you don't take off regulations. Investors need regulatory protections. That's why they're there. If you don't have it, they're going to be concerned. But in terms of whether it's reporting standards, when you do, even in the U.S., there's a lot of things you have to do on reporting standards. There's ways of getting to the same place without doing several steps. So they're just cutting out a lot of the steps on some of the reporting requirements. They're cutting. They're actually making things easier in terms of filing things online. So I think that infrastructure that you're seeing is where you're getting some of that boost from the Middle East, because they're actually a little bit more sensitive on the regulatory side. That's where I think you're getting some of these some of the excitement around putting these things in the Middle East. And I think that's why people are jumping there. I mean, I think, of course, the tax regime is great for talent. That's also another way of attracting talent. And they're attracting quite a lot of talent there.
Well, I know the taxes are a huge incentive. One of my good friends I lived in London before moving here to New York, and I was going on a walk or a run with one of my friends. He's a banker in London, and he was talking to me, and he's doing the math. He was telling me, it seems like a no-brainer. Like, obviously, in London, I get the training, and there's a lot more happening. But he's doing the math, like 0% income taxes. If I take even a 15% pay cut, that's a lot. And the cost of living is far. I mean, London, New York, these financial hubs, even Hong Kong, the cost of living is so high. Your rent in Hong Kong, your rent in London, your rent in New York for your job is going to be, at the early stage of your career, let's call it, $2,500 a month, right? That really eats into your savings, and I think in Dubai you can live, or in the Middle East. Well, to some extent, Hong Kong, there is this infrastructure where if you want to raise a family, it's while working a more intense job, it's possible. Domestic helpers, that's a big aspect of Hong Kong culture, and in the Middle East as well. And so you kind of have that breathing room. Whereas I feel like in London or New York, it's tough. You have to struggle.
I think the gap is actually between those places in the Middle East have actually grown wider. I mean, for example, if you're in New York, you've got federal taxes, you've got state taxes, you've got city taxes. You got to eat, you've got tax on every time you buy something for food or in a restaurant. And right now, everything in the U.S. seems to be going higher and higher from an inflationary perspective. And that's similar. You're getting similar things that's happening in London. I wouldn't characterize Dubai as cheap. I think it could be quite, it's still going to be, I would say, a decent amount of your salary you can put away to live something comfortably. But at the same time, you're right. It's going to be less than what you're spending in New York. It's going to be less than you're spending in Hong Kong. Of course, Hong Kong's a little weird because rent is so out of whack. A lot of other things are cheaper, but the rent is just very, very expensive. So you get this, your consumption basket is tilted more towards rent. So you actually have to sort of look at all of your expenses to really figure out what's the best place to be. But I do think you're going to have a little bit higher quality of life in Dubai than some of the other places as well. I mean, I love New York, but I think it's getting to an expensive place to be, and I think people are recognizing that.
Daniel, where would you live today as a young person to maximize opportunity?
I think maximizing opportunity, especially if you're talking the finance space, I think you've got it right. I mean, your main places you would go to would be New York. It could also be in Hong Kong. I think in terms of, I would say that Dubai right now is not quite to that level yet. I expect it to grow and to be there because I think they're really just starting to get going. But then if you're looking in Europe's a little bit of a tricky place. I think that you've had London was your big financial center, and there's still a lot of hedge funds there. But I think with Europe and with Brexit, I think there's going to be some changes there. So I think it's not as much of a no-brainer in terms of going to London. So I think New York still wins pretty well, and I think Hong Kong does as well. Because again, what people sort of forget is that U.S. is the biggest economy, but China's number 2, and it's got more people than the U.S. So there's I think there's going to be a lot more growth in China. So there's going to be opportunities in this region. So if you can find ways of getting an internship or a place to work here, I think that it can definitely be helpful.
I recently got a text from a friend that he listened to one of my other podcasts, and he liked this ending question. I'm thinking about doing it more, and it's to Quant, because this podcast is talk to quants and quant traders like yourself, like who run a lot of money or maybe doing more sell side stuff. But the question goes like this: are there any lessons that you've learned about life that you've taken from quantitative trading, perhaps about edge, perhaps about risk? And I always like these analogs. I'd love to hear if you have any.
No, I think in terms of when you look at quantitative investing, when you look at putting this all together, risk becomes a very important topic. It's also something you spend a lot of time on. And so you really have to realize risk. And there's also some things you sort of realize about yourself, is that people themselves are not really geared, or they don't really contemplate risk probabilities as well as they think they do. A lot of times there's ways of talking yourself into positions. There's ways of falling in love with a stock. And Wall Street has a lot of these sayings: don't fall in love with the stock, because these are actually ways of getting traders to sort of think about risk. It's saying, look, you can love a stock too much and then not only lose the money you made, but actually go negative and end up with a losing position. So that's why you actually have to have your risk models built properly. They have to be integrated into your system. Everything from not just alpha generation, implementation. You then have to look at trading costs. You have to look at in terms of attribution. So your quantitative in terms of evaluating signals has to be through it, but also your risk has to be there as well. And I think that's what you have to realize is it's okay not to do everything in your head. Have a good model that you trust, follow it, and then make sure that if it's part of the process, you'll have a lot less ways of going wrong. You still lose money. I mean, you can still have bad trades, but I think it'll keep you out of trouble that you see from a lot of players that put either too concentrated bets and it goes wrong, or not getting out of position fast enough. Your risk is very important for anything you do. So make sure your risk model is attuned to your horizon that you're trading. It has to be fast if you're doing high frequency. It can be a little bit slower if you're holding periods a couple weeks or a few months. Make sure it matches, and then always make sure that your models are updated and looked, and make sure that they're tweaked and appropriately built for your investment process, and make sure that you look at it from time to time that it's still fit for purpose.
Wonderful. I think that's a great place to leave our conversation. Thank you so much, Daniel. I really enjoyed. All the best.
Thank you. No, this has been great. It's been great to talk about a lot of things, especially things in Asia, and people don't really sort of appreciate that there's a lot more things going on than just US, and there's some interesting things going on outside of it, and it's always good for them to take a look at and see what's out there.
100%, man. Take care.
All right. Thanks.